The title of this presentation is Building Portfolios That Snap Back Like a Military-Grade Rubber Band. I like to talk about math because science is something that's a little more difficult to define. In fact, most things that we say were scientifically true 100 years ago, we no longer say are true. Psychology has changed, nutrition has changed. Many models of complex systems have changed so much that they're just no longer true. But math is something that's real. Math is the science, the language that you use to describe the physical world. When new discoveries happen with math, they usually add to whatever is already known about it. So I'd like to talk about math, and we use math to build portfolios. We use math specifically to describe three characteristics of investments. The first one is value. How much do you pay for it? What is it worth? Quality. If a company has a higher quality, earnings, return on total assets, return on equity, it's going to be worth more. It's going to have a higher value than companies that don't. Similarly, growth, a higher growing company is going to be worth more, have a higher value or valuation than a company that's not likely to grow well. We look for investments with the right mix of these characteristics, and it turns out that they're much better even if you get the same return as an index might over the long run. These investments should fall less and hopefully snap back much better. And it's something that we've empirically demonstrated seems to be true. Math is something that's worked for a very long time. Warren Buffett is best known for using math at Berkshire Hathaway, and Charlie Munger talks about how simple it is if only people would do it. Warren Buffett brought to our attention the performance of John Maynard Keynes during the Great Depression. From 1927 to 1946, he made a great deal of money at a time when, in fact, the UK stock market didn't do anything. Warren Buffett also showed us in a letter that he wrote called The Super Investors of Graham and Doddsville how well he and four other managers who followed the same approach using math and those three characteristics did extremely well, making very good returns over the market when the market made hardly any returns during the late 60s, 70s, going into 1980s. And then we have the example of Jean-Marie Evelard, whose co-manager Charles DeVoe, now at International Value Advisors, did very well, making money every year, 2000 to 2002. So these are not the only examples that we have, of course. Morningstar uses a similar approach. They use math to describe the best companies in the world, the best companies that have the highest quality companies that have high returns. They pick those which are the cheapest using valuation metrics. And of course, these are all companies that have good growth. So you can see that the blue line shows they fell less and then they rose far more quickly than the broader S&P 500 index. Similarly, we try to do something similar with our portfolios. The kind of yellow line there shows you what a 50-50 mix of stocks and bonds would have done during the Great Recession and how long it would have taken to come back. But it's possible to construct portfolios with these metrics that might do better on the downside and snap back more quickly. See the green star. That's what we're aspiring to do. Now remember, in order to get these returns, investors need to be able to suffer the inevitable volatility which will happen. If you're taking half the risk of the market, which might be down 20% or up 26% over any given 6-month period, you might expect to lose 10 or make 13. In other words, 1 million would turn into 900,000 or 1.13 million over a given 6-month period. And we'd like for our clients to understand that's what could happen. But the reality is it's a little bit less than that because the lower risk investments and the higher risk investments are not perfectly correlated. In fact, you would, instead of losing 10%, might expect to lose 6 to 7%, depending on how well you did versus the index, or be up 10 or 11% over a given 6-month period with a moderate allocation. So you should hopefully do better than only taking half the risk over the 6 months than the market. And if you're an even lower risk investor who only wants to take, say, 30% of the risk of the market, well, you're still going to take, you're still going to have volatility that could be, your portfolio could easily be down 6% or up 10% or so. If you're moderately aggressive, taking 70% of the risk, well, you might be up anywhere from down 11 to up substantially more. What a lot of folks find interesting too is how often do these portfolios over 6 months actually lose money? And the answer is that if you're taking 70% of the risk of the market or more, you might expect to be down 1/3 of the time. If you're taking half the risk in a benchmark, you might expect to be down 27%. And if you're doing things mathematically the right way, substantially less. Similarly with portfolio 30% type risk allocation, you would expect to be down anywhere from 10 to 14% of the time at 90% confidence. But even more important than the volatility you expect to have, which is unavoidable over 6 months, if your math is right and you have a portfolio of high quality companies that are at good valuations with reasonable growth, you should expect to lose money far less frequently and far less in terms of total amount over a 3-year period. We call that risk of actually losing money that you can't make back. And if you have these constructed right, it's possible for you to make money taking 30% of the risk of the market or half the risk, and to almost always make money even with taking 70% of the market risk. Now, we see clearly that that is not what happens in an index. It's there, as we talked about earlier, very large drawdowns and then a long time to get back causes people to get out at the wrong time and back in at the wrong time. So losing money on the way down and then not making the money back on the way back up. So this is just the way things are. And if we can educate on this and we can construct portfolios the right way, it's possible to do substantially better. Now, as you can see on this chart, it's a little busier, but if you're taking 70% of the market risk in an index, you might expect to be down substantially. Even if you're taking only half risk of the market, you would expect to be down 3% or so a year. But that's not what happens if you skew your portfolio in the right way using these mathematical ratios, better valuation, higher quality, and hopefully reasonable growth. The combination is a very, very robust and resilient approach. And if we look to see how often was money lost over a given rolling 36-month period, a 3-year period, you can see the moderately aggressive benchmark of 70% stocks, or the Vanguard S&P 500 index, lost 28 to 30% of the time. And the moderate portfolio with 50% stocks and bonds would have lost money 17% of the time. But if you're using math the right way, it's possible to substantially reduce how often money is lost, so that in a 50-50 stock bond portfolio, a moderate portfolio, moderately aggressive portfolio would lose money 3 or 4% of the time, but a moderate portfolio maybe only at 95% confidence, 1 or 2% of the time. And this is the kind of thing that holds up when we look at the investments. So we know that few investors can tolerate losing 50% twice in 15 years. And we have a team that dedicates all of our efforts to finding smaller boutique investment firms who have skin in the game, who don't want to lose money that you can't make back. It's serious money. It's their money. It's their trusted clients' money. I spend a lot of time. I'm Ken. I do a lot of this. Joey is the master of all things that have to do with retirement transition. Adam is a relationship manager with us who likes to look at the what ifs of all the negative things that could happen. Kurt on the right is a lawyer, a Harvard educated estate planning attorney. Christy knows more about forms than I've ever thought I once knew about all of the things and how we work with Schwab and TD Ameritrade. Amanda next in the glasses is an accountant. She's an enrolled agent and a paraplanner, handles a lot of our back office reporting. And Erin, the newest member of our team, is working on her CFP. She's a paraplanner. She helps, works very closely with Joey, especially to make sure that our clients get everything that they need. And she's very proactive at reaching out to folks, telling me, for instance, to call clients in Charleston when we had the hurricane, when I'm overwhelmed with other things that I need to be thinking more about my clients. So we have a group here that we think we can take care of everything that you need. And we'd love to talk to you more about how the math might work in your portfolio. It's important to remind everyone that over the long run, since 1970 or so, U.S. and international stocks have earned about the same returns, nearly 10% per year for both. That's since 1970. But over the last 10 years, international stocks are behind by about 5% per year. There's been a substantial lag. For whatever reason, maybe it's the low rates, maybe it's the quantitative easing, maybe it's the EU project, but there's been a substantially lower return over the last 5 years. Similarly, if you look at emerging markets, we've seen the same thing happen. The U.S. is run in green there, while emerging markets lagged. Towards the end of this, it looks like emerging markets are finally picking up. And with these economies being cheaper, having cheaper stocks than in the U.S. and having faster growing stocks, if we can find companies with the right quality, I think it's a fantastic opportunity. Investors, retail investors, human beings leave nearly half of their returns on the table for the big institutions to take in the S&P 500, in bonds, and in allocation funds. And in an environment like today, where most world areas are overvalued, especially the United States is substantially overvalued on a 10-year valuation metric, and international and emerging markets are undervalued, there may be opportunity to make twice the return in those markets as they would make in the United States. Unfortunately, few investors have enough of their assets allocated overseas to benefit from this. So you have to think a little out of the box, and you have to be willing to take what might seem like a risk on the surface, which in fact probably isn't, if you do your math right. Remember, none of this should be considered to be investment advice. That has to happen between an advisor and an investor individually. If you want to learn more, you can call us at 864-272-0818. Or in Cary, North Carolina, 919-648-2955. You can simply email me, ken at globalviewinv, like victory.com, or you can visit our website, which is globalviewinv.com. We might not have the answer for you, but we'd love to see how we can use this math to improve your odds of keeping the serious money you've earned. Thank you.